Welcome to the deep dive. Today we are witnessing a genuinely fascinating financial market paradox unfolding.
It really is.
We've got two enormous assets, Bitcoin and the US stock market, and they're moving in utterly opposite directions, which just makes you ask, what crucial signal are we missing?
It's more than just a momentary blip. For weeks, we've seen how these risk-on assets, especially tech and crypto, they tend to move together.
Right, in lockstep.
But then last Tuesday, everything changed. We saw the traditional market, the US indices, flashing some major fear, while Bitcoin just surged. It seemed totally impervious to that anxiety.
Let's look at that fear first, because on that specific Tuesday, you had the major indices, the Dow, S&P 500, the Nasdaq, all of them falling.
All in the red.
There was this really noticeable selling pressure, and it was focused right on the tech sector, specifically those AI-related stocks. The whole market was just holding its breath.
And that breath holding was focused on one company, really, the bellwether for this entire AI surge.
Yeah.
Nvidia.
Precisely. Nvidia is not just another stock. It's seen as the foundational heart of the entire AI infrastructure right now.
Oh, absolutely.
When they release an earnings report, the global market treats it as this non-negotiable health check for the whole industry's future.
And leading into that report, the anxiety was just palpable. Investors were terrified that the company wouldn't meet its sky-high expectations.
Potentially signaling that the AI rally might be losing steam.
Exactly. And we saw it in the price. Nvidia stock dropped 2% that day alone, which pushed its monthly losses towards 10%.
But against this backdrop of institutional fear of tech sell-offs, Bitcoin does the totally unexpected. It rises spectacularly, 4%. It hit an intraday high of $93,700. So our mission in this deep dive is to look past that surface price action, get into the on-chain data, and figure out who was driving that move.
Yeah, was this genuine sustainable strength? Or was this just a short-term liquidity play?
We have to analyze the foundations. The price moved, sure, but was it smart money laying those foundations, or was it just retail enthusiasm?
That's the billion-dollar question.
Okay, let's unpack this. Let's zero in on the technicals of Bitcoin's bounce that day, because the numbers here are really important. BTC jumped from a daily low of around 89,300.
All the way up to 93,700.
A huge move.
And that bounce didn't happen in a vacuum. It occurred right off a key technical area.
Okay.
Analysts call this zone between about 88,000 and 91.5 a critical order block.
Which is basically, what, a bunch of buy orders?
It's basically a zone where, historically, huge amounts of buying demand have been waiting. The fact that the price bounced hard right there suggests there's some real underlying technical resilience.
So we have a technically sound bounce happening exactly when traditional risk assets are being dumped. The initial thought is one of two things, right? Either Bitcoin is acting as a genuine safe haven for capital, or it's just the new gamble for speculative money that got spooked out of tech stocks.
And that ambiguity is exactly what we need to resolve. I mean, technical support is one thing.
Right.
But seeing new capital actually confirm that support is another thing entirely. For a move like this, a 4% move, to have real legs, we need to see conviction from the institutional players.
The whales. The ones moving billions.
Exactly. And to see that, we can't just look at global trading volume. We've got to dissect it.
This is where we bring in that fascinating metric, the Coinbase Premium Gap, or CPG.
This is such a critical insight. It's so often overlooked in surface analysis, but it tells you so much about the quality of the buying.
So to get the CPG, you need to understand the difference between two major exchanges. Think of it like a two markets analogy. First, you have Coinbase.
Right, the U.S. institutional hub.
The platform of choice for the big funds, the institutions, anyone needing that regulatory clarity and, top-tier custody.
I mean, you have Binance.
The global retail giant.
It's the dominant exchange for individual traders all over the world. Massive liquidity, derivatives, you name it.
So the CPG just measures the Bitcoin price difference between these two places. And what's really crucial here is what you expect to see in a healthy bull market.
In a healthy, institutionally driven market, the CPG should be positive.
Meaning the price on Coinbase is a little bit higher than on Binance.
Exactly. Because institutions are willing to pay a small premium for that compliance, that security, the ease of settlement you get on a platform like Coinbase. A positive CPG is a sign of strong, confident, long-term institutional demand from the U.S.
And here is where the story of that big 4% rally starts to unravel a bit.
Yeah, it gets interesting.
We looked at the on-chain data from CryptoQuant for that Tuesday, November 17th, and despite that really strong headline price move, the data showed the CPG had actually fallen sharply to negative $114.50.
That is a staggering figure. We have not seen the premium shrink to those negative levels since, what, early February this year?
So a negative number means the opposite is true. The institutional exchange, Coinbase, had cheaper Bitcoin than the retail exchange, Binance. What are the implications of that? Why would institutions let their main platform trade at a discount?
Well, the implication is pretty clear. The institutions were not the ones buying. They were not driving that rally. They were either completely on the sidelines or maybe hedging somewhere else, but they were definitely not making big spot purchases on Coinbase.
So the rally was just...
It was predominantly fueled by retail participants on Binance reacting to the momentum. It's classic FOMO, fear of missing out.
Okay, but can I just push back on that for a second?
Please, yeah.
On that classic retail FOMO is fragile idea. If retail investors are the ones consistently buying at these key support levels while the big institutions are just sitting there, doesn't that suggest maybe a new level of conviction from, a younger, more decentralized group of investors? Is retail buying always so fragile anymore?
That is a really fair challenge. And look, the retail sector certainly has more maturity, more long-term holders than it did 5 years ago. No question.
Okay.
However, market stability really comes down to volume capacity. When the market sees a big shock, a sudden negative macro event, it's the institutional capital moving in these huge, disciplined blocks that stabilizes things. They absorb the selling.
And retail flows just aren't big enough for that.
They're powerful for momentum, but they're much more susceptible to fear-based selling cascades. They're almost always the first to sell off and cut their losses when a real macro shock hits.
And we've seen this before. There's a history here with the CPG being a warning sign.
There is. The last time the CPG dipped this low, it hit negative 138 back in February of 2025.
And what happened after that?
That was a clear signal. It came right before a period where institutional capital pulled back, leading to market stagnation and then a correction not long after.
So the takeaway for you, the listener, is that this rally, it looks strong on the surface. You see a 4% green candle off a key technical level.
But the deep data, that negative CPG, it signals the foundation just isn't secure. It's like a car that's moving fast, but it has no oil in the engine. It's moving for now, but it's really vulnerable to seizing up if it hits a bump in the road.
Speaking of bumps in the road, let's pivot back to the source of all this anxiety in the first place. The risk tied to Nvidia. Why should we, as crypto investors, care so much about one chip maker's guidance?
Because institutional investors categorize assets by risk appetite. The same institutional money that buys a high-growth AI stock like Nvidia is often the same money that allocates capital to Bitcoin.
They're in the same bucket.
The same high-beta, high-risk bucket. They both thrive on optimism about the future of tech and liquidity. When optimism is high, they buy both.
And we saw that intense optimism back in October. Nvidia CEO Jensen Huang announced the company had secured a staggering $500 billion in chip orders for the next 2 years.
An incredible number. And that figure gave investors this clear, long runway of guaranteed growth for AI infrastructure.
But the story has shifted.
It has. The new concern isn't that Nvidia is failing. It's that it's failing to live up to its own kind of mythical expectations. Recent forecasts still project really strong revenue growth, 56% year over year. That would bring their revenue close to $55 billion.
Wait, 56% growth is still phenomenal by almost any standard. How is that cooling?
It's all relative cooling. Institutional portfolio managers, they're not focused on the absolute number. They're focused on the rate of change, the expectation versus reality.
Okay.
We saw periods where Nvidia was posting triple-digit growth rates, 100%, 200%. And those were the numbers that justified the extreme valuations and fueled all that market euphoria.
So dropping down to only 56%, even though it's a huge number, introduces doubt.
It introduces doubt that the AI boom can sustain its current trajectory.
Yes. So that slowdown, even if the growth is still substantial, it shifts the whole risk assessment. So what's the psychological impact on the same institutions who are already sitting out the Bitcoin rally, which we know from the negative CPG?
The implications become cumulative. A slowdown in Nvidia's growth is like a cold shower for tech enthusiasm overall.
And we know institutional money is already sidelined in crypto.
So if the stock market, especially the NASDAQ, reacts negatively to that Nvidia report, Bitcoin is highly likely to catch a cold. And there's no deep-pocketed institutional buyer confirmed by the CPG ready to step in and absorb that macro volatility.
So the market just becomes this fragile retail momentum play colliding with institutional macro fear.
Very precarious situation.
Okay, we've laid out the conflict. A strong technical bounce on the surface versus a weak institutional foundation underneath, all happening under the shadow of this Nvidia risk. Let's make this actionable. How can you use this knowledge in your own planning?
This analysis really gives us two critical data points to watch, which allows for some preemptive decision-making.
Let's start with takeaway number 1. Use the CPG as your main confirmation signal. The market is testing everyone's patience right now. Don't rush to buy those green candles when it's just a retail momentum surge.
Exactly. That institutional foundation is missing. For short-term traders looking to ride a continued move up, the advice is simply to wait.
Wait for what, specifically?
You need clear confirmation that institutions are back. That means waiting for the CPG indicator to close its current negative gap and turn significantly positive again. That's the signal that they're willing to pay a premium. That is when the wave is truly safe to ride.
And on the flip side, if you're looking to short the market, that negative CCG gives you some justification, knowing there isn't deep institutional support to absorb any selling pressure.
Precisely. Which brings us to takeaway 2. Treat the Nvidia report as the volatility trigger. Even if your portfolio is 100% crypto, you have to treat the earnings report as a key traffic light.
Green light, red light.
Green light is good results, general optimism spreads, macro risk eases. Red light, bad results, or a major downgrading guidance means you have to be prepared for immediate, strong market volatility.
And scenario planning is everything here. The goal isn't to perfectly predict the price move.
No, not at all.
It's to prepare for the potential outcomes based on this data we've discussed.
Right. If the CPG is negative and the Nvidia report is a disappointment, you should assume there's a good chance of a sharp dip. Do you have cash ready to buy better prices in those support zones we talked about?
And conversely, if Nvidia surprises to the upside and the CPG somehow flips back towards zero, are your positions ready to take some profit into that strength? You can't wait until the news is out to be asking these questions.
You have to be prepared beforehand.
Finally, takeaway number 3. Embrace the long-term perspective. Focus on accumulation. For anyone who trusts the core value of this technology, these daily fluctuations, this short-term dance between institutions and retail, it's all just noise.
The market's overall trajectory over months and years is not going to be defined by a single 4% retail rally or one quarterly earnings report. If you believe in the tech, then temporary institutional withdrawal or some price consolidation is simply an opportunity.
An opportunity to accumulate calmly rather than, anxiously watching every little tick of the chart.
Train that emotional stability. It's the most important muscle.
So what does this all mean? We've seen the visible strength of this 4% rally just collide with the hidden weakness of the institutional flow, which was signaled by that severe negative CPG. And that leaves us with a really provocative thought to close on. Given that Nvidia's growth is cooling but is still very robust at 56%, and we know institutional money is on the sidelines for now, are we seeing a permanent decoupling of crypto from mega-cap tech? Is Bitcoin finally finding its own independent path? Or is this just smart institutional money using the CPG and other data, just waiting patiently for a slightly lower, more confirmed entry point because they know how fragile a retail rally can be?
The market is waiting for that signal. The best you can do is analyze the data clearly and make sure your scenarios are ready for the week ahead.
We hope this deep dive helps you make effective, informed decisions. Stay well informed, and we'll catch you on the next one.